going to switch gears for a bit for a Q&A session with Steve Wittmuss of Farm Bureau Financial Services. Steve has a valuable example to share of how carriers can succeed using advanced tools in underwriting and across the organization. So Steve, let's start off by learning your story, where you were at, how did you decide to start using analytics, and how you implemented the process. Steve?
Great. Well, thank you very much for asking me to participate today. Farm Bureau Financial Services is a regional property casualty insurance company, and we write business in 8 states. The majority of our book of business is in personal lines, but we do have a nice-sized commercial book, and we're looking to grow that book quite a bit. So we identify our markets as Main Street business. I think we were fairly typical for a commercial writer of our size. We did not specifically underwrite our work comp business. We underwrote the rest of the risk, and if we liked that part, we took the work comp. So a couple of things occurred to us. First, our loss ratio really blew up around 2010. So if you remember the chart they used earlier that showed the winning companies and the losing companies, we were definitely on the losing end of that. Our loss ratio was well above what our competition was. So while the rest of our book was profitable, our work comp was very unprofitable, so we knew we needed to make changes within our work comp book of business. Second, our underwriters had limited knowledge on what to look for when it came to underwriting work comp. If we didn't underwrite it as a general practice, they didn't have the knowledge to do that. So then the question was, how do we transfer the knowledge they need to underwrite the business to our underwriters? And if our only response to our underwriters was to tell them to go underwrite work comp, we were not going to be successful. So as you back up in my career, my first introduction to using analytics was when I worked with personal lines auto. So I knew how predictive modeling worked. In personal lines auto that I was involved with, we were able to level out our loss ratios by risk class with rate differences between the classes by up to 40%. So I knew if I found the right tool that predictive modeling would work for work comp too. Using data analytics allows you to be more efficient. You now underwrite by exception rather than by trying to write everything. So you can identify which ones you want to go after and which ones you can send through the process very quick. Even if you have experienced underwriting staff, they still only see a fraction of the potential risks that are out there in the world. And many times they never see the overall picture on how a risk is profitable. They just know sometimes if they've had a large loss or any loss on a type of risk. So that means underwriters work based on their rules and not necessarily always company rules or data and facts. If they had a large loss on a risk, they may exclude that type of risk going forward forever, even in the big picture if it was a good risk. So predictive modeling frees the underwriter to make that decision based on facts. So as a company, we decided to use predictive modeling, and now we have to introduce it. So when we introduced it to our underwriters, the first thing we did was start to tell a story. Here's our problem, here's what analytics is, and here is why it will help us. So remember to keep it simple, and graphs work better than numbers. So if you remember the example earlier where they talked about company A and company B and used that graph, I've been using that graph for a number of years to help explain what analytics does and why it's important for us to go there. When you introduce it, there will be pushback and there'll be outliers from the data. You can't hide from this, you just have to acknowledge it. So everyone out there has an example of somebody they think would be an exception. Just acknowledge that that person may be the exception, but he belongs to a group, and for the group as a whole, it is not the exception. Next thing you want to do is make sure you set up systems and processes so your staff can be successful. The actual underwriting decision needs to rest with the underwriter. Any tool you use, Valin is no exception, is just a tool. The underwriter still needs to make the final decision. Part of my background is in claims, and this is where you can get into a lot of trouble when the decision maker, you outsource that to a company or a process. So you want to make sure your underwriters are still the decision makers and use this as a tool and not a crutch. The other thing we did with this is we started off by focusing on the bottom 1/4 of our business that was unprofitable. So when they talked about the bins 1 through 10, we really focused on those bins 8s, 9s, and 10s. So we built underwriting rules but gave the underwriters leeway on how to implement those rules in each of the bins. An example would be if the risk was in bin 5, they could use up to a 10% debit or a 10% credit, but it had to be in that range unless they got underwriting approval from their manager. And so on bin 9, they could use a 10% debit up to a maximum debit depending on the state. So we also recognize it will take a while to implement entirely within our book of business, especially on the renewals. You know, we have some businesses out there we've had a long time, and it's hard to raise their rates if all of a sudden they fall in the bins 9s or 10s if they've been with you a long time and have not had a loss, say, over 5 years. So you have to give your underwriters leeway, especially as you implement it, to have them get comfortable with the data and be able to use it. Then the last thing we did was shared our success stories. So in our case, we're able to show, within 6 months, we were able to show that those risks that we had that were in bins 9s and 10s, as a group, we were giving credits to them, even though analytics show that they would have been our worst risks. And after 6 months, we're able to show that now we're taking a debit on them. And so as a whole, it's making a difference. We're showing that to the underwriters, and they know that they're making a difference one policy at a time.
Thanks, Steve. So that's a good introduction to how to start introducing underwriters to analytics. Maybe now you can talk a little bit about senior management and why senior level commitment is so important, number one, and number two, what does it take to really secure that level of commitment within your organization?
Well, this is no different than any other major project. It has to have key support and proper resource allocation from senior management, and it has to cascade down through all the various levels of your company, whether it's communication, the IT resources, or even a willingness to sell the program. As I mentioned earlier, there'll be pushback in multiple areas. So I've identified 3 of them. The first one is underwriters. You're going to get pushback from your underwriters. First, you're challenging their knowledge. You need to let them know that instead of challenging their knowledge, you're giving them additional tools that will help them better understand the risk they are underwriting. And again, this allows them to manage by exception. So instead of you telling them that they have to work harder on all their underwriting risks, for, in our case, work comp, you're identifying, here's the band that we want you to work with, in our case, the 8s, 9s, and 10s. The other ones you don't need to spend as much time with, so you're stair-stepping them into it and allowing them to spend their time on the risks they need. Second, as I mentioned earlier, you're putting them in the middle of the renewals and the insured and the agent against the data. So I think you acknowledge the issue and give them time to move at less than full speed towards implementing on renewal business. But as we've seen, once they know it's working and once they see the success, they've increased their usage. The second group you'll have pushback from is agents. So, you're changing the rules, so you need to be able to tell your story, need to twist it towards them. In our case, we have captive agents, so it's probably a little easier for us to introduce it and not lose the business. I know if you're right in the independent market, that may be more of a challenge. But we had to actually stop our quoting process to make this happen. Prior to implementing Balun, our agents could go in and quote and rate all within their operating system on their computer without having an underwriter get involved. Now, since we started Balun, so we could get it in quick, we've made it so that they're doing work comp. At a certain point, it stops them and tells them they have to contact their underwriter. Their underwriter then runs the Balun report, and then it gives them the amount of quotes. So we've really changed what they had to do, but we've told our story. We've explained to them what we were doing, how much money we were losing, and they bought into it. We've also explained to them our long-term goal is to make that part of the process so they don't have to stop in the midstream of rating. Again, with agents, they're always going to know somebody that's the exception, and that's just something you're going to have to work through. The third group that you're really changing is the client, and you're moving their cheese for some of them. So first, remember that you're only changing some of them. There's a number of them where the rates will go down or their score will be such that their rates could go down. You won't hear from this group. What we have found is when a client searches for new coverage because they're interested in leaving us because we've raised their rates, often they stay with us because we're still competitive. If we were extremely underpriced in the market, us going up a little bit is not going to change that the first time through. Now, hopefully, as we keep moving forward, their rates will continue to go up until they're paying the proper amount for their risk. And third, you just have to have faith that you trust the numbers and the data, and that if you lose business, it's going to another company that's writing it at a loss.
Thank you. You touched on this a little earlier, but I thought it might be good to discuss what you think are some best practices when you start to implement predictive modeling practices. Perhaps you can share the Farm Bureau process and approach.
Sure. First, we engaged our underwriting staff early and often, and we try to do that as often as possible on any project, give them advance notice well in advance what we're looking to do. So in our case, we needed to explain predictive modeling. We did that. We started talking to them probably in September when we got serious about working with Valin and knowing we were going to go there. And we implemented it the following March. So this gave our underwriters time to get used to the idea, plus it allowed us to use the underwriters to help develop our processes. We also, again, I talked about, we went with the manual process so we could get it implemented sooner, and I think that's a benefit too, as opposed to letting it drag on. So after we engaged our underwriters, we made the decision not to change more than we could handle. So we started with the minimum we thought we needed to be successful, and then we figured we could work on the rest once we got some victories. So as I talked about, we focused on those bins, 8s, 9s, and 10s. We developed rules that still give the underwriters the ability to make the decisions. However, to show we're serious and want to stay engaged in the process, if a risk falls in the bin 10, they have to have sign-off from their manager or myself before they can do anything with it. And that's whether they keep it the same, whether they give it max credits, or whether they get rid of the business. So they have to participate, come to us as management, and we're part of the decision from that point on. In addition, we required it on new business right away, but again, we gave them a little more leeway when it came to renewal business. The next piece of the puzzle would be training. So we have a very specific process that we use for training on any new process we introduce. So first, we start by developing what we call as a job aid. And this is a step-by-step instruction on how the process will look going forward. This is an important first step as it keeps all future training grounded to this document. If changes need to be made to the process as we go forward, we must come back and change our job aid. Once we have the job aid written, then every month we have a 1-hour call within our department, and we usually do this with 3 20-minute segments, so they're a little longer segments. And when we have a change like this, we take one of those segments and we announce the change along with why we're doing it and what it means for our staff. This ties back to that senior management because it's usually myself or somebody else at my level that's giving the introduction, so they know that there's support behind it from upper management. Then after that meeting, we have a 1-hour training session, and the training flows from our job aid to the staff. If needed, we can schedule additional training after that, but we always start with a 1-hour training session. Then once the new process starts, we just have one place for the staff to go with their concerns or problems. So that way we can see if we have a systems issue, a problem that's becoming a trend, or is it just staff that needs time to adjust and they're just kind of talking through the process. It also provides a consistency with the information we provide back to both our agents and underwriters. We think that's very important. The last thing I'll talk about is finally is that I have my own 6-week rule. So after a launch, immediately I check with some people to see how things are going, get their view on how things are moving forward. Then I kind of check back against in 6 weeks with that group to see how they're doing. That's when I see attitudes usually really start to change. Short of a catastrophe, I try not to make any significant changes to a new process or program until you get that 6-week mark and see how that's going. So as a manager, I just think it's good to have some informal checkpoints.
Thank you, Steve, for sharing that. Of the dozens of carriers that we work with, I think we've seen from Farm Bureau that your process has been incredibly successful. So, thank you for sharing some of the specifics with our audience today. Next question for you. What are different ways that carriers can think about measuring success and underwriting improvement? Yeah,
for measuring success, for us, it has been easiest to track our renewal changes. So you take what you had in the prior year and compare it to the current year and see what you have. So for us, in the first 6 months, I can give you our numbers for what our book of business has done. I can track it by the company-wide. We can look at how the data is being sorted by bins. I can see what we're doing with each bin. We can see how we're using the data for scheduled rating. I can also see how the premium has changed. So I can show you how our underwriters are using the tool per underwriter on the renewals. I can also, as I said, I can tell you about the amount of premium increase we have seen, as this alone is paid for the program. For us, new business has been more of a challenge. We continue to look for ways to do that. We're just starting to get reports on that, and that's more of us trying to understand the process and how we can track it best. Again, we got it in a very short period of time, in 6 months from the time we really got serious with Valon. We signed the contract at the end of December, and we were up and running by March. So to get everybody on board and to see everything, it's taken us a little bit of time. So our loss ratio has improved since we've implemented the process, but it's only been a year, so I doubt that was due directly to the data this quickly. But what I do believe is that we have an awareness down by our agents and underwriters that we have an issue with work comp. And we've gotten rid of a number of poor performers already because of that awareness. So we believe it's making somewhat of a difference to our loss ratio even this early. One other way that this has helped, and again, I'm not sure how you measure it, but it's underwriter engagement. So we talked earlier that said our underwriters, prior to using Valon, we'd never really underwritten work comp. So our underwriters are really concerned about having to do so. But what you see now are underwriters out there, and they're discussing work comp as a group. They're engaged. They feel confident they can make good decisions. They're interacting with our product staff and our risk management staff. So by sharing our successes, we are having the underwriters see that they're making a difference, and their enhancement or their engagement on this process is really skyrocketed.
Thank you, Steve. So just to recap a little bit of, what you shared when you decide to implement analytics, tell a story, keep it simple, begin, in a small way, make sure that you've got senior level commitment on board so that the project can be successful and get the resources that it needs. And as you evolve your underwriting organization, engaging the team early and often seems to be one of the key reasons that you've been successful, along with the very defined process that Farm Bureau uses. And then it seems that you're using measurements that are both hard measurements that say, hey, we're already getting a return, but also looking at different wins in terms of underwriters really, getting on board with thinking about how to underwrite work comp, et cetera. And there are multiple ways to kind of measure the results that you're getting early on. So thank you for that.